What's going on, you guys? Today is Wednesday. We are about a third of the way through November, and because it's Wednesday, I wanted to pop on real quick and talk about some of the wins that we've had with our clients. Now, this win is a little bit different than others. We're not talking about a purchase where they got a great amount of seller concessions covered or anything, but we're actually talking about a refinance in this market. So with the refinance, of course, we're not talking about like an interest rate reduction refinance or anything like that. We're actually talking about a cash out debt consolidation refinance and how you may be able to leverage a program like this even if the interest rate doubles in some scenarios. So let's break it down. I'm going to real quick show you guys with a debt consolidation tool how the numbers work, and maybe it makes sense for you. What we have here is an existing property. This is a property that may have been bought, around 2020, I used an example of. And so because I bought it in 2020 in this scenario, what I actually used is a 2020 average for the average purchase price of a home in the Pierce County district, which came to just under about $420,000. All this information I actually found online and can be easily Googleable to verify everything. So with that going forward, the purchase price originally about $420,000, and due to appreciation over the last 3 years, it's been absolutely nuts. That same home on average is now worth around $522,000. So in a matter of years, over $100,000 earned in equity that we're gonna learn how we can leverage to potentially get you out of a little bit of a debt scenario. If we scroll down a little bit further, it's just talking about the loan itself, the remaining balance, all that jazz, after you would have paid over the last couple of years. Currently, the loan on average in 2020 has an interest rate of 3.38%. Again, I'm using averages, and I think it's pretty fair to say that the average loan around that time, or maybe a little bit after, is around the 3 to 3.5% mark. So we're going with 3.38 to make it as realistic as possible. Of course, this may not pertain to you. Maybe you have a little bit higher of an interest rate, or maybe even lower. I know some people snuck in the 2.25 rates for a while, which is just phenomenal. So always be sure to reach out and check if this actually makes sense for you, because again, this is very, very general. I'm just trying to get the point across. So we scroll down a little bit further and we start getting into the numbers. So here is the existing mortgage side right here on the left, and then this is going to be the proposed right here on the right, talking about two different scenarios and how we can make all the numbers work. So the property value, like we talked about, estimated on average $522,000 based on Pierce County. The loan amount remaining for the existing, somewhere around $370,000, and the proposed in this scenario would be $464,000. But real quick, let's tap and look at the average debt for America's household families and see what in this scenario we're actually paying off. So that is going to be right here. What I did is I went into Google and I just looked at the average debt for the average American and combined two of them, male and female, because the averages were different between genders, to get a household balance, to just use this as an example. So for the household, the average credit card or revolving trade line debt was around $12,500 at a 2%, which is me being, a little bit conservative. Minimum payment, that would still be $252 a month. Depending on the credit card that you actually have, it may be upwards of 5%, which would more than double this payment right here. But we're using the lower just to prove a point. The average vehicle loan in a household is just under $40,000, somewhere around $750 a month, depending on the term, whether it's a 60-month, 84-month, all that jazz. Personal loan average about $32,500 with an expected payment around $600. So all in, the average household on top of their standard mortgage has over $1,600 in debt. So with that being said, let's break down the numbers. So the existing mortgage with all the debt, $369,000, and then they're going to have that debt that we just talked about down below. The proposed would be a $464,000 loan, and you can increase that loan above the purchase price, again, because you had all that equity to start with. And then we are going to change up the interest rate. Of course, we cannot offer the 3.38 or whatever interest rate you had at the time, so I plugged in a 6.99 with a VA scenario. Again, We do a lot of VA business, and so if this pertains to you, then fantastic. This could be pretty realistic. If you do not have a VA loan, that's okay. We can check out different loan programs, and we can do this up exactly for your scenario to see if the numbers make sense. So with this proposed loan and the large increase in loan balance, we've also included $83,000 in debt into the mortgage to consolidate. The numbers on the right-hand side over here show that your principal and interest payment previously with the low 3.38% was just under $1,800 at $1,769. Taxes and insurance on average $538 a month, making your total payment somewhere around that $2,200-$2,300 a month payment for your home, which is just phenomenal. But if we start looking at the debt of that $83,000 for the average home, we have additional car payments and credit cards and other debt, which totals that $1,500 around additional debt on top of the mortgage. If we look at the proposed with the kicked up interest rate but the inclusion of the debt into the mortgage, we have a new proposed principal and interest of just under $3,100 at $3,086, and taxes and insurance remain the same, and so that's just another $538. All in all, the total for outgoing expenses in a household for the first scenario or the existing scenario would be $3,900, and the proposed, even with the kicked up interest rate, would be $3,624, which means you would have a net savings of $285 per month that you guys would have additional access to that would not be outgoing. Now, what's really cool is if we actually take this a step further. Of course, you would have to go above and beyond and plan for this, but it would be possible. So we have $285 of net savings a month. If you were to apply the $285 in savings of your net savings on a monthly basis towards the new mortgage, you would actually save about 34 months or 2 years and 10 months off the mortgage, even with the higher interest rate. So you can cut back on debt, get rid of that nasty debt, have savings monthly, and if you decided to focus those savings towards your mortgage, pay off your home even quicker. Because of this consolidation tool, I really wanted to reach out and show this to you guys because there's a lot of huge amount of savings that can be done if it makes sense. And so if that is you, I recommend you reach out and see how someone can help.